Well, they're certainly not as attractive as they were last year. I would add though that while many have used mortgages as a core part of their portfolio, we're much more willing to not own any if the valuations weren't attractive, and we didn't for the vast majority of our core plus strategies lifetime that we found better things to do. Uh, Happily, post the regional bank crisis of a few years ago and the increased level of overall interest rates, we found mortgages dramatically attractive relative to, for example, investment grade corporate bonds. And we lean pretty heavily into that to have essentially a zero weight a few years ago in our core plus strategy to as much as a third of our portfolio. And it was all fundamental valuation driven. We just found the spread relative to investment grade corporates and certainly the quality differential between an investment grade corporate bond and mortgage market broadly, just very compelling. So we leaned into that quite heavily. Where does that take us today? That we had a pretty massive shift in the mortgage market just so far this year. At this point, reevaluating is the best way to describe that. But certainly not as a target rich environment for us there as how we deploy capital going forward. We're as to where we go from here is a challenge. Is quite honest the answer. I say a challenge, but at the same time, markets change every day, and our ability to cast a wider net across so many different areas of the fixed income marketplace, we're not constrained by having to have a certain allocation in investment grade, mortgage-backed securities, et cetera, that we have the ability to cast and have a pretty wide net across the U.S. economy, which has many ways for us to deploy capital. And we look forward to seeing what 26 affords us. What you might add to that?
Yeah, and just a reminder to our investors and the audience, the way we invest in mortgages is just different than the index. So if you were to compare our portfolio on a coupon basis and a production basis, it would just look very different. We don't own many, if at all, of the legacy, COVID era mortgages that have very low coupons. The large majority of our portfolio is almost substantially all of the portfolio is in the 4.5% to 6%, 4.5% to 5.5% coupon range. So our portfolio will do best if rates kind of stay where they are or trade in a relatively narrow range. Then we'll just continue to take that coupon income that is well above market in terms of where cash and where the ag is.